That first letter of notice of demand for payment usually gives you between 10 and 21 days to pay it. If it's not paid, technically the IRS lien arises. After that, in many cases, the IRS will send you a notice of federal tax lien, which basically puts all creditors and the public on notice that you owe the IRS money. There are ways to prevent that. We can appeal prior to the lien being filed, provided you get to it in time. If you receive a notice of federal tax lien in the mail from the IRS, a few things will have preceded that. First and foremost, you need to either file a tax return and have owed and not paid, or you didn't file the tax return and the IRS has assessed you taxes or your business taxes based on information they have. In order for the tax lien to become effective, the IRS first has to assess you the money. Technically, once that assessment is made, they've sent you notice and demand that you owe that money, the tax lien automatically arises. So what the tax lien is against is any property you own, real or personal. So that tax lien would affect any real property, a house, rental property. It'll attach to any vehicles you may have, any assets you have that a lien attaches to. So technically, if you sell any of those assets, the IRS has a claim on those assets. Now, as a practical matter, if you sell a car, it's not going to affect that because the lien would have to actually be on the title in most states for the IRS to get paid. However, where it really comes into effect is with real property, say your house. The lien would have to be filed in the county where your house is located. So if your house is located in Fairfax County, Virginia, and the notice of federal tax lien is filed at the county courthouse in Fairfax County, Virginia, if you sell a house, say for $500,000 and you owe $250,000 on your first mortgage, and there is no other liens against the house, if you owe the IRS money, out of that $250,000 that you would ordinarily be entitled to, the IRS would take whatever they are owed out of that money at closing. Now, what would happen if, let's say you owe the IRS in this scenario $500,000 and there's only $250,000 in your house in equity? We would have to get what's called a tax lien discharge or discharge of tax lien, which is a negotiation and an application that has to be made with the IRS, whereby you would apply to have the tax lien released upon satisfaction of certain criteria. In most cases, that criteria is the IRS gets whatever they deem and whatever is negotiated that they should receive. So what will typically happen is we would make this certificate of discharge application. The IRS, we'd go back and forth with them. Typically, the real estate agent would be allowed to be paid property taxes, any taxes on the sale, and whatever that net difference is, less fees, and the first lien holders that are superior to the IRS lien, the IRS gets the balance. And if it isn't enough to cover your whole IRS balance, you would still owe the remaining amount to the IRS.